be a trend, tariff wars continue. So the other reason I think that treasuries went up in yield early today by a lot on the long end is I think people are starting to realize the budget problem I've been harping on. I'm sure people are tired of me talking about it, but it's absolutely one of the most important issues in the markets. We have a massive interest expense problem. And the budget deficit is at $2.2 trillion, if you want to be honest about it, not use the official numbers that understate things, is $2.2 trillion. And the amount of bonds that are being issued so far in fiscal 2025, which started October 1st, is greater than the number of bonds that were issued by the Treasury in fiscal 2022. I mean, this is just unbelievable that we have the same number of bonds being issued that we did during that massive stimulus that involved altogether $7 trillion of money that caused the inflation. So in the next recession, I strongly believe that long yields will go up after an initial decline, which may have already happened. So people are starting to realize that it's dangerous potentially to own long-dated treasuries going into recession, because if the budget is 2.2 trillion in the hole right now, if there's a recession coming in the near term, it could easily go to $3 trillion or more. And so you can understand why people are leery of owning bonds, and with countries not getting along, the funding of the treasury market by foreigners is not likely to increase. So I believe rates will go up in the next recession at the long end. That's why, Scott, I've been telling you the last several appearances, I want to be in 2s, 3s, 5s in the bond market. That's where we've been, and that's the area that's doing well. And I think that's going to continue as the long end almost doesn't have a good case from this starting point of yield being, in the 4% category.
I want to ask you lastly, if I could, the criticism that has now developed around the rollout of the tariffs, not just in the math-making process, which was highly suspect to be kind, but now that you have some people, high-level Wall Street types, speaking out against the methodology, the rollout, the severity, and what they would think is a better approach moving forward. There's also the lack of understanding, I think is fair to say, from investors about what the end game really is here. Is it about negotiating better deals? Is it about drawing revenue to deal with the deficit and the interest payments and the like that you mentioned are a problem as well? I'd like to hear from you directly what you think about this process, how it's played out, and whether you join the critics who are becoming louder about these issues.
Well, I think the process, if you can call it that, is standard Trump. I mean, he's keeping people off balance, and I think he's doing it to a greater extent than even a normal Trumpian process would be, because he was short-circuited instantly in his first term. They were doing it to him. They were keeping him off guard with all of these hoaxes and all of this lawfare and all this stuff. And now he's like saying, I can do that. I can play that game too. I can be one step ahead of you and keep you off balance. And he's doing that with his political adversaries domestically, and he's doing it with the counterparties in other countries. And I would expect that this is not going to calm down. That tweet, I guess, this morning that people talked about the tariffs were going to be delayed. There is no way that's going to happen. I think Trump is going to keep this going. And I don't understand exactly how he calculates, or the administration calculates, this strange formula to set these tariffs. It just doesn't seem to make much sense to me mathematically. But it's at least it's a formula. Whether it's logical or not, it's a formula. Otherwise, it's just going to be totally arbitrary. But he's keeping people guessing, and he's not going to back down. I don't think so. So this is something that's going to have to play out, and we're going to be dealing with this, I would say, certainly for weeks or months, and not just days. So I think investors need to stay on the defensive mode. We certainly position for that. And the extent to which investors hold cash, I would continue to do that until we get something more of a sustained bottom. As I said earlier, I'm looking for 4,500 on the S&P.
Jeffrey, we'll leave it there. It's a really important day to hear from you. Thank you for making time for us. We'll see you soon.
Thanks, Jeff. Good luck, everybody. See you soon.
All right. Yep, you as well. That's Jeffrey Gunlock joining us exclusively here on Closing Bell. We're in the market zone, by the way. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of this volatile trading day. What a day. Again, this doesn't tell the story. It's the intraday moves are just insane.
400 S&P points is what we spanned today, which is pretty hard to believe. On Friday, we talked about that crazy Friday, Monday dynamic. You get highly stressed markets, you get washout readings. It looks like internally markets super oversold. Both ready to rally hard, but also those are the dangerous conditions from which you sometimes see a really messy spill lower. And we got both, basically both there. So everybody knows, if you look at the historical stats, when you got so much downside skew in this direction over multiple days, usually you don't get hurt buying it if you have a multi-month, multi-year time frame. On the other hand, there's just nothing that really emboldens you to feel like we finally hit that point. Now, the down 20% from the high, we got that. It looked like a bit of a selling crescendo in the overnight futures into the early morning. So some of the things are lining up. But as long as we're going to be twitching with every headline, it doesn't really seem like there's much of a coherent message. You realize there's massive upside risk if we get something genuine that the market believes, but at what cost if you're sitting here for it? So we don't really know on what basis we're making a fundamental case here. And I think that's the big thing that keeps real money a little bit sidelined. It's just like, look, we know the earnings are wrong. We don't know by how much at this point. If there's a quick reversal on the policy front, which doesn't seem likely, it could be no harm, no foul. You still got 1,300 or 1,100 S&P points above you till the old highs. So it's kind of that much play in the system right now that we're dealing with.
There's a tremendous amount of lobbying. To your point, there's a tremendous amount of lobbying underway from people in high levels on Wall Street who are telling the administration that you got to do something, that you got to pivot off of this seemingly no pivot stance, or you risk things getting pretty messy in the markets that you might not be able to contain in a minute. I know that for a fact because I've talked to people who are talking about it.
Oh, yeah. That's why I called the billionaire backlash before. You are saying, I mean, look, the actual policy as described, it's one of those things that reminds you of something that's unsustainable by definition will not continue. The problem is, and we got the headline, the Treasury Secretary is going to be, leading these negotiations with Japan. If we're talking about country by country negotiations, like the market's patience will run out unless you get some kind of a clear strategy behind that. Until we get to that point, what are we dealing with? We're dealing with seeing if the market just gets bled so dry in the short term that it kind of doesn't matter for long-term money whether things work or not. The Fear and Greed Index, the CNN Fear and Greed, it closed last week at 4 on a 1 to 100 scale. I mean, it's kind of pinned at the most negative you can be. So sometimes that's enough to just exhaust the selling and get a little bit of relief. Now, is relief going to be good? Is relief meaning maybe policymakers don't think they have to move quickly to change something? So that's a little bit of the feedback loop that we are in right now. At some point, maybe we can take comfort in the fact that mostly the U.S. economy is inwardly focused and only 15% is trade dependent, and it's not necessarily a make or break for the economy. But companies, we saw a decline in consumer credit. That hit this afternoon.
Yes,
you almost never see revolving credit back off that sharply unless you have a real shock to consumers' mindsets. And that's what we're going to be dealing with as we get to the earnings reports, as everybody keeps saying.
Yeah, it is a paralysis at the corporate level and deep concern at the consumer level. We know that. We'll ring the bell here. What a session we've had. A lot of tech is looking green, certainly the mega cap. So the NASDAQ looks to finish green today. We'll wrap it all up in overtime with Morgan. I'll see you tomorrow.
That's the end of regulation. Faith, Investor Services, and Bright Portfolios ringing the closing bell at the New York Stock Exchange. Community West Bank shares doing the honors at the NASDAQ. Stocks closing mostly lower as a wild session comes to a close. Looks like we got gains on the NASDAQ here. But the S&P 500 touching bear market levels early in the session. The Dow swinging more than 2,500 points in trading today. And the NASDAQ trading in a nearly 10% range. It was, to say the least, volatile. Scorecard on Wall Street. But the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off today. We will be all over this volatility throughout the hour, including with noted investor Dan Niles, who says a recession is not his base case scenario. But let's get right to this whiplash market action. Joining me now is Warren Pies, 314 Research co-founder, and Steve Sosnick, Interactive Brokers chief strategist, along with CNBC's Leslie Picker, with some fresh comments from one of Wall Street's most important voices. But gentlemen, I will start this conversation with you because, as I just mentioned, and Warren, I'll start with you. We did have a NASDAQ composite and a NASDAQ 100 that finished fractionally higher, and an S&P that finished fractionally lower. It looks like 50.62 maybe is where we're settling out on the S&P. Warren, we came into this session arguably very oversold here. We saw a massive flush out, a lot of margin calls coming into today. Is this a dead cat bounce, or is this a market testing its bottom?
Yeah, thank you for having me. I think there are two important price levels to define for viewers. So if you study history and you go back and you look at where should we expect this market to bottom without a recession, then I think we're at a place that's a pretty compelling entry point already, which is like anything below 5,100, you're looking pretty good. However, if we have a recession, then we're 500 points lower. My view is we're not going to have a recession, that the policies that have been proposed are not sustainable. It's kind of more should be looked at more as an opening negotiation, and therefore I do think we're going to avoid recession. So I think when we look out 1 year, this is going to be a pretty good buying opportunity for investors. And we've been pretty cautious coming into April. So yeah, I think it's there's no telling if it's the actual bottom. Sometimes you have to decide if you're going to be early or late in these situations. Personally, I'd like to see technical confirmation, but sentiment is really washed out. We see sentiment on our institutional measures, retail measures, and the VIX at 45, 25% for returns from that point historically. So I think we're getting close to a real bottom.
Steve, we've had these conversations, you and I have on the show. We've had these conversations with other folks coming into this year as well, that this was going to be a volatile year. I mean, look no further than today, and Warren just touched on it, but you have a VIX that's at very, very elevated levels as one sort of marker of the activity we've been seeing in this market. Your thoughts here, especially as we've talked about in recent months, the role that individual investors have been playing in stock moves in general.
Yeah, I'm Morgan. There's a lot to go on here. I mean, the volumes have been incredible. We set records on Friday in both stock volume and option volume. So that's a tremendous lift. And from what we could see among our customer activity, the volumes were steadily increasing throughout as the week went on. Interestingly, among our 25 most active names, as of last week, 24 of them were to the buy side. The only exception was Alibaba, and that was very slightly net sell activity. So our customers remain buyers. There's definitely still a big, faith component in the market. Clearly, there were participants who had some issues, whether there were leveraged investors, people got a bit overexposed. I do think some of the selling came from risk parity funds, which then sort of require you to sell stock as volatility goes up, which is kind of counterintuitive there in some ways. But basically, I'd say many investors are holding firm, and you could see from today's activity when we went, from down 5% to up 3.5% in about a microsecond. It's telling you that there is still residual demand for stocks, and nobody wants to miss a rally.
Warren, I want to get your thoughts on what we've seen in some of the other asset classes as well, because crude oil, something I know you track, hit its lowest levels since April of 2021. It looks like we actually finished with crude back above 60 in the close a couple hours ago. But you also saw bond yields, which had come off dramatically in recent sessions, tick higher today, too. What are these markets telling us?
Yeah, I think the first with oil, there's been a supply problem for a while. It's something we've highlighted for our clients. And I think that so there's a whole nother drama going on there with OPEC returning more oil to the market than investors had expected. And ultimately, there's a lot of confusion around tariffs. Is it inflationary? Is Is it growth negative? The answer to all those questions is ultimately yes, but it's mostly a growth scare. It's a growth negative. And so obviously crude oil, one of the most economically sensitive assets on the menu, has gotten hit. Bonds are a little trickier. I think they've been acting more or less like you would expect until today. And then we saw a lot of selling. The rumors going around are that these were potentially foreign sellers of treasuries. I don't think we have evidence for that story yet, but I mean, that just shows that that is a potential consequence of this entire quote unquote trade war that Trump has initiated, is that we have, we buy stuff and foreign countries buy our debt and equities. And so if we unravel that relationship, then obviously the potential is for those capital markets to suffer. So those are really the oil's a growth story, and in bonds, I think they're a little bit caught between two forces here, but I wouldn't make too much out of today's action.
Yeah, you raise a key point there, too. We'll dig into that a little bit more. The fact that there's a national security element to how our economy is currently structured, which I think speaks to how these tariffs were invoked from a national security standpoint. There's a whole debate to disentangle there. But Warren, Steve, stay with us because we do have some breaking news from Washington. So let's get to Eamon Javers at the White House for more. Eamon.
Hey there, Morgan. Just within the past couple of seconds, the White House has finished a Oval Office pool spray with President Trump and President Benjamin Netanyahu of Israel. The President of the United States saying he is not considering any type of pause in terms of tariffs going forward, and in fact, doubling down on his threat to impose an additional 50% tariff on China if that country doesn't lower its retaliatory 34% tariffs on the United States. So the president here holding a firm line and explaining that he feels that he has a once-in-a-generation shot here to reset the global trade table, as he put it, in terms of the U.S. Relationship with countries around the world. Interestingly, Morgan, in this Oval Office session with Benjamin Netanyahu, the Israeli prime minister said that Israel is committing to President Trump that it is going to lower its or eliminate its trade deficit with the United States. So the implication there is Israel is going to find some way to buy a lot of American stuff and do that pretty soon. And what President Trump is saying here is that what he wants is other countries to come to him to negotiate. And in order to negotiate, what he wants them to do is to come down to zero in terms of tariffs and then go below that in terms of what they call non-monetary tariffs or non-monetary barriers to trade. So the president here putting down a pretty hard line here, but saying he's simultaneously looking to raise revenue with these tariffs and have them be permanent while also engaging in negotiations, Morgan.
He's been consistent, and so has most of his administration with that messaging, even if it seems like it contradicts itself. I am curious, you sort of just took the words right out of my mouth, Eamon, and that is how closely now should we watch the dynamics between the U.S. and Israel as a template from which other countries start to maybe negotiate their own bilateral agreements, assuming that's what comes out of this?
Morgan, you used the word template. Benjamin Netanyahu used the word model in terms of what he wants the Israel example to be here. He said, we're going to do this, and we think that we can be a model for other countries. Clearly, these are two political leaders who are joined at the hip in many ways politically, Netanyahu and Trump. And so this is among the friendliest negotiations that you might see on the global stage. But we also saw Scott Bessent, the Treasury Secretary, signal earlier today that he is opening negotiations with the Japanese government to lower tariffs and non-tariff barriers. So, I guess the answer is we'll see, right? I mean, this is both a White House that is saying that these tariffs are permanent and also a White House that's saying that it is engaging in negotiations to eliminate them.
All right, Eamon Javers, thank you. Notable that it's two very significant allies of the U.S. on the geopolitical stage as well that we're talking about here to start this process. Now let's bring in Leslie Picker with headlines from BlackRock CEO Larry Fink, who spoke earlier about the market turmoil. And he had some very pointed things to say in his messaging today.
He absolutely did. He was speaking at the Economic Club of New York, and Fink seemed pretty bullish despite the recent market volatility.
I would say in the long run, this is more of a buying opportunity than a selling opportunity. That doesn't mean we can't fall another 20% from here too. But I do believe over the long run, the vitality of the United States will persist.
He was a little more concerned about the macro picture, though. He said that the, quote, ripple effects of potential tariffs is going to be long-standing. And he said the economy is, quote, weakening as we speak. In fact, he said most CEOs he talks to say, quote, we are probably in a recession right now. Fink said President Trump is focusing on areas that in the short run are, quote, very inflationary and destabilizing the economy. He said there's a, quote, need for the administration to focus on these pro-growth agendas, things like tax cuts and deregulating and streamlining the permitting process. He said the market's not focusing on these things and forgot about the power of AI, Morgan. But, you know, you can't blame the market given just the various headlines, today being the perfect example of that.
Yeah, and it was interesting because you did see some of the tech names and Mag 7 names actually lead things higher today, even though I realized it was a mixed picture for stocks overall. I was actually in the room. I was at this luncheon that the Economic Club hosted today, and it was an hour-long, wide-ranging conversation on the record. They covered a lot of topics. Just to put a little more meat on the bone around the recession, you know, CEOs that I've spoken to, you know, say we may already be in a recession commentary. He pointed to the airlines as a canary in the coal mine, just seeing the changes that are happening in real time around travel, for example, Canada. So it's going to be one to watch as we start to get earnings season underway, not only with the banks and with BlackRock on Friday, but also with airlines starting to report too, and see whether that's an early indicator of what consumers are doing and how they're changing their behavior.
Absolutely. And it also very much echoed some of the things we saw from Jamie Dimon's letter. That's the chairman and CEO of JP Morgan. This idea that, you know, he believes we're already slowing down the economy, whether we go into a recession as a result of these policies remains to be seen, according to Dimon. But just the act of slowing down, it happens very quickly. And he said that unless things are reversed quickly, they can have long-term effects. It's not one of those things where you can kind of reverse it down the road and everything goes back to normal.